Vera, are you there?
I was hoping to, because I thought she'd cover some of the points. But, I mean, I can really
Okay. Ladies and gentlemen, welcome to this APPG Africa inquiry on a just energy transition. Thank you to all our speakers and all our guests in the room and online who've come to listen to this. We had our first session a couple of weeks ago, I think it was now, which was very informative, and we are looking forward to this session as well. My name is Johnny Oates, Lord Oates. I'm a co-chair of the All-Party Parliamentary Group on Africa. I am joined to my left by Patrick Brady MP, who is SNP Member of Parliament and a Vice Chair of the All-Party Parliamentary Group on Africa. And we are the two parliamentarians that will be taking part. And I am delighted to also say that on my right, we are joined by the chair of the Royal African Society, who has so kindly sponsored the secretariat of this all-party parliamentary group, and helped us on a number of inquiries over the years, and really make the all-party parliamentary groups what it is. Welcome to the room. As members probably know, the reason that we decided to start this inquiry was a sense that some of us had picked up when visiting or meeting with parliamentarians from Africa, that there was a bit of concern about how the just energy transition was being taken forward and being understood in the UK and in bits of the global north. So we really wanted to get proper perspectives from Africa to inform us, and that's the purpose of this inquiry. This session in particular is looking at the issue of climate finance, the finance need to enable a just and energy transition, and what can be done by the UK government domestically and in terms of its international role in terms of that just energy transition, and particularly the climate finance around that. And the session will also seek to unpack the barriers for governments to mobilise private and public finance to improve energy access and to understand additional progressive sources of domestic climate finance, and assess the pros and cons of carbon taxes and carbon credits and carbon markets. To discuss this, I'm delighted that we are joined by Dr. Vera Songwe, co-chair of the high-level expert group on climate finance, who's joining us online. Welcome to you. We're also joined by Emil Lee Amin, Managing Director and Head of Climate Diversity and Advisory at BII, British International Investment. We're also pleased to be joined as well in the room by Taliola Oyegoke from Sustainable Energy for All. No, who is in the room? No, online.
I'm sorry.
Online, I'm getting confused. Also joined by Makupa Nsandaluka, who is in the room, Policy Officer, Tax and Natural Resources Governance at the Tax Just Work Network Africa. Dr. Kevin K. Hiruki, Vice President, Power, Energy, Climate Change and Green Growth African Development Bank Group, who is also with us in the room. Dr. Hubert Danso, who I think is either online, who is online, CEO of Africa Investor, and also online by Iskander Azimi Vanoit, co-chair of the Climate Action Network Climate Finance Working Group. So thank you all for joining us. We're incredibly grateful to you giving us the time. We are going to ask panelists questions, myself and Patrick as the two panelists. We would ask the panelists to respond between 5 and 7 minutes, and I will try and give you the warning when you're about a minute away from that finishing time. But if we can keep the responses to that, so we can get through a lot of information that we have. The first question is going to be from me, and I'm going to put to Dr. Vera Songwe, and that is, what is the role and contribution that international grants, concessional, blended and private finance can play in supporting an ambitious and just energy transition in Africa? And are there elements of the just energy transition that can only be funded by public finance? And final part of that question, how can the private sector be de-risked for communities and workers, and to improve energy access for low income and remote communities? Dr. Songwe, could I ask you to respond to that?
Thank you very much, and it's a pleasure to be with you today to tackle these issues. It's a loaded question, but let me see how I go through it very quickly. I come to you today, one, of course, as an African, but secondly, as the co-chair of the independent high-level expert group on climate finance, and we just released our second report at COP a week ago. I think when we talk about climate finance on the continent, and very quickly, I always say that, Africa is ground zero of the climate crisis. Over the past 60 years, Africa has recorded a warming trend that has generally been more rapid than the global average, according to the Intergovernmental Panel on the ICC. What we have seen is that, for example, in 2022, which was the 5th warmest year on record for everybody, it was the 2nd warmest year for the continent. This has meant for Africa, 110 million more people that have been impacted by the climate crisis. And of course, if you overlay the climate crisis with what we call the poly-crisis, which is the war in Ukraine, the war in the Middle East, tightening of monetary policy in the United States, it has led to inflation and has worsened a lot of the macroeconomic balances of African countries, which has meant that many African countries have been shut out of markets and do not have access to additional resources, which is why this conversation is very important, because we do need, as Africa, concessional resources to be able to move forward on the climate crisis. The first part of resources that are needed actually are not really resources. I always like to say it's policy. We need good policies on the continent, which can ensure that we can crowd in good concessional and or private sector capital. I think the good news is that there has been, and we're seeing this at COP now with the revisions of the NDCs, countries have taken ownership. They're redoing their NDC strategies. They're refocusing on what they can do on the policy side and what more is needed. The report that I put out with Lord Stern and the high-level group essentially says that we need about $2.4 trillion of additional capital annually to be able to fight the climate crisis, of which 1 trillion will come from the multilateral development institutions. Of that bit, and this is where it is important again to talk about what the international community can do. First of all, the MDBs. We need the MDBs to be able to deliver at scale. We're asking for a tripling of MDB financing. All of the MDBs put together today are at about $100 billion. They will never be able nearly enough to fund the climate crisis and the transition. So we need a lot more resources going into the MDBs, a tripling of those resources according to the Singh Summers report on MDB reform. In addition to the MDBs, what we also need is additional resources going to the low-income countries, which are grant resources, the IDA resources. It's unfortunate to say that IDA, the International Development Association, which is the global community's largest finance pool for the poor, has actually been decreasing every year for the last 10 years. So all IDA countries have been receiving less resources over the last 10 years from the G20, G7. And I think we cannot now add, for example, to the World Bank and the EBRD and all, an additional mandate, which is the climate mandate, and expect them to deliver on that mandate with a decreasing amount of resources that is going to finance this mandate. And so the grand portion of the MDB bucket must be well funded. And for us, that's IDA. We're coming up to the IDA replenishment, midterm replenishment conversation. And really, I think that will be the first indication of whether, the multilateral international donor community is serious about, getting countries to also include climate in their global development plans if they don't have additional funding. We also talk about the work that can be done with bilaterals and also the need for private sector financing. About 40% of what is going to be needed is going to come from the international financial community. 60% is going to come from the private sector. The private sector needs additional credit enhancements. They need guarantees to be able to ensure that, we can make sure that any investments are safeguarded. We need first loss portions that need to be taken. We need a lot of work. There's a conversation around bankability of projects. We need bankable projects and preparation. I think there's a lot that has been done in that space. Now we need project development and project preparation. Just last week while we were at in Dubai, a new facility has been launched, which is actually a project development facility with philanthropic capital of about $258 million to help begin to prepare these projects to go to market. Then there is the whole bit on domestic resource mobilization, and this is where the just transition really becomes important. In the domestic resource mobilization window, we have a big component that is going to have to come from carbon credits or carbon taxes. And it's unfortunate that 3 years after we've been talking about this, the Africa Climate Carbon Markets Initiative has been launched. We have not yet been able to agree on a common framework to get the carbon markets going. The carbon markets in and of themselves by 2030, 2050 will be an $80 billion resource for the continent. We always talk about the fact that Africa did not cause the climate change, and only 4% of the contribution, but we are the lungs of the planet. We clean the planet with the peatlands, with the tropical forest in Central Africa. And for this, I think we can put a price to that and make sure that with integrity, harmonization, and some transparency, we can move to a carbon price and eventually compliance and taxes. I think Mia Motley and the Bridgetown Initiative are talking about the 5% tax that we should be able to put on fossil fuel companies. I think part also, and this is my last point before you close me up, is on this domestic resource mobilization component as well. At least on the continent, we're talking about gas as a transition fuel. It is the tragedy of the continent is that we are energy resource rich, but we are energy access poor. We do not have, 600 million people on the continent still do not have energy. To transition from where we are today, where we're burning essentially trees, 16% of the forest on the continent today, we went from 24 because a lot of trees are being cut down. If we were able to use gas as a transition fuel while we move into hydrogen and more solar and more wind, I think that will also allow us, one, to have the base load to be able to power our industry. We need to do green industrialization. And the only way to do that is today to start fueling our energy systems with some gas while we work towards a just, honest transition. And we don't want stranded assets, and maybe we can talk about no new gas discoveries and no new gas exploration. But for countries like Mauritania and Senegal and Mozambique, where there already is gas and there's already exploration going on, I think it warrants it, and it's part of the just transition that we fund that to make sure that that can come to stream and come to fruition quickly. Thank you very much for listening.
Thank you very much, Dr. Songwe, and thank you for keeping time. Very grateful to you. I will pass over to my colleague.
Thank you, Johnny. So yes, I'm Patrick Grady. I'm one of the vice chairs of the All-Party Group on Africa, and I'm the chair of the All-Party Parliamentary Group on Malawi. And my question is to Amal, the Amin from the British Investment International, and it builds quite nicely on what we've just heard. I think or perhaps how should public money be used to mobilise and de-risk private investment flows to the clean energy transition in Africa, and what proportion of UK development aid and what other instruments are currently being used to do so, and what is its impact in relation to financial additionality, economic and other benefits, distributional outcomes, debt and policy space for host countries, and taxpayer risk in home countries.
Great, thank you. Is that great? Thank you. And actually, it's great to come after Vera, because I'm also a member of the high-level expert group on climate finance, and a lot of the issues that Vera referred to are obviously very critical to everything we do at BRI. I think, as everyone's aware, we're the UK's DFI, and so we are publicly funded, but we only do private investments. And I think what has been really interesting, particularly with the work of Vera and Nick Lord-Stern, has shown that the need for building out a very complementary ecosystem around the climate finance agenda, particularly for countries in Africa, where we know there is huge unmet demand for energy. And we also know that the role of the private sector is likely to be key, given that domestic utilities tend to be very weak, have had a very historical levels of underinvestment. Regional planning, sector planning can also be very challenging, which makes it hard to build grid infrastructure, particularly across regions. And so, as we know, at the same time, and I think sort of the second part of your question, which is also something that was specifically a focus of the recent report that was launched at COP28 and builds very much on the Bridgetown agenda, is this issue of indebtedness of many countries in Africa, and the challenges of being able to finance effectively the transition, their own domestic transition to net zero economies. And I think as we saw at COP28, and it's still going on, I mean, it's obviously a very, very live debate, this whole just energy transition. So the key really is how can the international community really be supportive of enabling countries to be part of this global transition. So I think as a DFI, and we work closely with many of our DFI peers, as well as the multilateral development banks, who the MDBs tend to work both with governments and also with the private sector, which is actually really, I think, essential. I also was 7 years in an MDB, so I see the value of working closely with governments to support them upstream, but being able to finance and invest in the bring and crowd in particularly where available domestic private capital into the power sector is key. And so we do this in, I would say, some very complementary ways to others. I think Vera mentioned the importance of project development. So we have, I mean, we historically have been almost fully private equity investment. We are now still 75% equity compared to debt. And when you look at what is needed to build out and support development of projects, it's really that early stage type of capital, which equity is, which can take much more risk and then help build out the projects that can go to the banks to get debt to grow. And I think when you look at, particularly in Africa, what there historically and currently is a real lack of is that kind of equity investment. So I think recognizing the very complementary type of financing we bring to the wider development finance ecosystem, I think is increasingly being recognized. And I think it's something that the high-level expert group has started to focus on. Just to highlight how we do that, we do direct investments, but we've also worked through platforms. So one platform that we established fairly recently is called GridWorks. GridWorks is a dedicated platform to finance grid infrastructure, so transmission and distribution, as well as also looking at mini grids across Africa. This is actually one of the critical challenges we see now, both meeting access to energy, getting power supply to people, but also importantly to bring in more power generation and build out the system, particularly renewables, which we know are very have intermittent challenges. But also just to highlight, we in terms of the type of financing, we also have some concessional funding. We did this year, we've invested in a couple of utility scale battery storage. So these are the types of technologies as well that I think as a DFI, we're bringing both concessional funding, but also working with partners around helping to build out those more innovative solutions that are going to be necessary as part of the part of Africa's just energy transition.
Thank you very much.
Thank you very much for that. And now I'm going to turn to Mpuka Nsandaluka, who, as I said, was from the Tax Justice Network Africa. And my question is this: should carbon markets, which we've already heard referred to, credits and other funding instruments such as renewable energy certificates, be mobilised to increase available funding and support conservation efforts? And what are their justice, developmental and environmental implications and risks, and how could they be better regulated?
Okay.
Easy
You see him
question.
looking at me because that's not.
I think that's a question for Telly.
Sorry, I do apologise.
Yeah.
Sorry.
It's fine.
Sorry, Talia, you're online.
Telly was online.
Sorry, apologies.
No, it's
I was looking away. Yeah. Gabriella, are you online?
Hello, can you hear me?
Yes, we can. Please go ahead.
Okay, perfect. Okay, so thank you so much for this time and being able to express our thoughts, especially from the Sustainable Energy for All angle and sort of the work that we're really doing to amplify the successes of such programs. Every year, that 6 billion tons of CO2 is put into the atmosphere, and it's putting, as we know, on the atmosphere under great stress and continuously deepening our climate crisis. So the need for innovative financial and technology solutions to tackle this crisis is very urgent. It's very necessary, but I think it's not really about, because they are great tools and they are able to give great responses despite sort of the criticism that has sort of flooded their activation. However, it's now how we implement them, how we're able to put in these structures and make sure that they work effectively in the environment. It's important to highlight that globally we are very far off from our SDG goals, of ensuring affordable, reliable, sustainable, and modern energy for all, which is the core of sustainable energy for all's mandate. So utilizing carbon markets actually serves as a powerful instrument to propel, sustainable development and high integrity climate impact. Using the example of Africa, and I will dive a bit more into the work that we're doing with the Africa Carbon Market Initiative, where we're really supporting and thinking through the how. And why I say the how is so important is because there's one thing to deploy financial instruments, there's another thing to ensure that it's ring-fenced enough for it to be successful. So it's very important for us as well to think through how we are activating these markets. Utilizing carbon markets is critical, especially for continents like Africa. Majority of people don't have access to electricity. The continent generates around 2% of its annual, let's say, carbon market credit potential, for example, as opposed to other parts of the world. And carbon markets and its potential, carbon markets are expected to grow at about $1 trillion industry by 2037. Africa has the opportunity to play a much greater role in helping not itself, but the entire, world really fight climate change and present itself as a solution provider with regards to this. At the same time, I think that, and someone said something the other day that it's a driver, it's a tool, but it's more than just economical aspects. We also look at the fact that, it has high developmental priorities, such as expanding energy access, creating jobs, protecting diversity, improving health. 1 in 4 women in Africa dies from the fact that they don't have access to clean cooking. And this can be a powerful tool to incentivize and ensure that, this work is actually done. So part of the work that we do as Sustainable Energy for All, as one of the core functions, is that we support the Africa Carbon Market Initiative, and we really help in the sense of providing capacity and technical assistance to governments, especially now that, carbon markets, you hear it everywhere, but the truth is that there's not a full concept and understanding of really the potential, as well as the liabilities that it may pose if it's not, implemented in the right way and doesn't have guardrails to how to effectively ensure that the indigenous groups and local communities and governments themselves are protected from exploitations, etc. When it comes to RECs and, RECs carbon credits, they still fall under the same credit, and I would speak to them broadly within that same, categories. That right now what we see is an oversaturation because there's cheap prices and companies really see it as an instrument for bridging the gap between their limited action and high commitments. But really and truly, it's so much more than that if we're able to actually leverage corporate structures. And that's part of the work that the Africa Carbon Market Initiative is looking to do as well through its country carbon market activation plans, is really through thinking through end-to-end blueprints that ensure that, we're not just starting these carbon markets and, putting them and saying, okay, this is a great tool, but effectively ensuring that they're implemented the right way and they actually get the required benefits that are needed through their activation. I would like to emphasize, however, that, I'm speaking a lot about carbon credits and RECs, etc., because that was the question that was directed to the organization, but it's still, it's just a part of it. It's not the solution. There's this overinflated view that, you know, carbon markets would basically be this holistic solution to solving our climate change and energy transition challenges. It's a part of it, and it could be very instrumental too, but there still needs to be a lot of work in achieving our just energy transition. You know, there's need for wholesome reforms and, you know, driving of, you know, a unified international public financial architecture, as well as thinking through a shift in our, you know, strategy for it to significantly increase low-income countries' access to accessible and appropriate financing, and to also support renewable energy initiatives. We must address institutional, political, and legislative barriers, you know, that hinder this penetration into, you know, green innovations, technologies, especially for developing countries and least developed countries. So it requires that we make a push for initiatives that, you know, don't just start off but can be sustained. And that's why the institutionalization, the training, and the application of these incentives are very critical, because they have also the negative effect of, if not done properly, could, you know, be turned as opposed to a tool for development. It will be counter to that aspect of growth.
Thank you very much. And again, thank you very much for keeping the time. Now, Patrick, over to you.
Thank you. Okay, so now we come to if we can send a look at from the Tax Justice Network Africa. My question is, what tax policies and innovative progressive sources of taxes can and should be introduced to increase vital public climate finance for the just energy transition in Africa?
Thank you. For a moment, I panicked there thinking I read the wrong question, but thank you for that. So coming from the tax justice movement, I think our big perspective on this issue is equity and fairness, right? Especially when we think about the context of the fact that it's the global north countries that polluted the earth, and therefore they should pay for it. And when we think, I was glad to hear Dr. Songwe, and I think my colleague who just spoke earlier, speak about the issue of domestic resource mobilization, but also the need to reform the international financial system. I think now there's been talk about how do we reform the international financial architecture, because, as you know, corporate tax abuse is one of those issues that undermines domestic resource revenue mobilization in Africa. So when we think about, for example, the latest report around Africa and how much is being lost, 89 billion is being lost from Africa through corporate tax abuse. That could be revenue that could go to, for example, to climate adaptation, which as of the latest UN report says we need about 53 billion United States dollars. So how do we begin to address the structural issue of transforming the international tax system? And I think the UK has a big role to play on this, given that we know that, you know, London and the UK and its subsidiaries is a big player when we think about corporate tax abuse. So that would be the first thing. How do we address the structural issue of transforming the international system, and what role then does the UK play in that? But coming back to the question, I think I'll focus on this question, looking at it from a global equity point of view, as well as the national equity point, which I'll address in the second round. I think when it comes to thinking through fairness and inequality in the current debates about tax and the energy transition, those are the two things that we think about. And when it comes to global equity, we've noted that several of the taxes currently being discussed shift the burden from the rich countries who have contributed the most to the climate crisis onto developing countries. And in this case, I'll cite the policy on CBAM, the EU's current policy on carbon border adjustment mechanism, which is one example, which is estimated to cost a country like Mozambique about 2.5% of its GDP, as well as decrease its exports by 60%. So when we think about some of these policies that are being passed in the EU and the implications, for example, on trade in Africa, these are some of the dynamics to think about, right? Especially when we are thinking about equity, which is a big concern for us. Now, getting to three key proposals that we would like to advance. So because of the premise that those who've polluted should take responsibility, the first proposal that we think is vital is the introduction of a carbon wealth tax and a top-up pollution tax. And the rationale here is that the wealthiest 1% that emit planet heating pollution, as much as 2/3 of humanity should take responsibility because they've caused the pollution. And this carbon tax would be progressive because multi-millionaires and billionaires would be paying it. But also when you think about the pollution top-up tax, it would be an additional tax component based on stock ownership in the world's leading oil and gas companies. And the discount would be applied when fossil fuel companies invest in renewable energy, just as an incentive. And the revenue potential of this is that an annual wealth tax of up to 5% on the world's richest individuals would raise up to 1.7 trillion annually, enough to lift about 200 billion people out of poverty, but also obviously address the issue of climate finance, especially when we think about Africa and the needs that are there. And our big concern and really big push is that it's progressive because it only will be levied on those rich individuals and polluting companies that are obviously responsible. The second proposal is an introduction of a corporate windfall profit tax. And this tax is an additional tax that will be applied to big multinational corporations registering sudden and significant increases in their profits due to external circumstances such as war or pandemic. This tax could only be applied to corporations with windfall profits above an average level, and the tax would specifically target oil and gas producers and mining companies experiencing excessive profit taxes. Potential revenue: recent Oxfam report estimates that 45 energy corporations made an average of 237 billion annually in windfall taxes between 2021 and 2022. As such, this has potential to indeed raise revenue that would be relevant to meeting climate action. Again, when we think about its progressivity, the distribution of impacts of a windfall tax depends on the extent to which the fossil fuel extraction companies attempt to pass on the cost to the consumers, which is of course the biggest concern. So how then do you design mechanisms that protect those that would be most hit and that are most vulnerable? I'll end there. Those are the two points.
Thank you so much for that. We're now going to move into some follow-up questions. The first question is from me to Amal and Taliola. And I think you've talked quite a lot about how public and private finance projects can be scaled up. If you've got anything to add to that, please do so. Could you also reflect on the key constraints that you see as slowing down financial mobilisation, including the struggle to meet the 100 billion target, although I think it may just have been met, but it wasn't for quite a while. Amal, could I perhaps turn to you first and then I'll come to you, Taliola?
Thank you. So I think, I did touch on many of these points in the previous intervention, so I don't want to repeat those, but I do want to reiterate the importance of developing the pipeline of projects. And that's as much as about taking that early stage risk in project development as it is about project preparation and other types of activity. And so I think that's clearly a critical part of starting to get to some level of scale that then can attract other forms of capital, whether it's domestic or international forms of capital. So this issue of mobilisation, I think, the way we look at it, BII, we recognise there's quite a need for a differentiated approach across Africa. So in South Africa, for example, which has a lot of domestic savings, it has a very sophisticated financial sector. There, the domestic capital markets are likely to be what is really going to be the first form of capital into scaling and enabling South Africa to decarbonise, so to accelerate the transition out of coal into cleaner energy. In other African markets where there's a real need to actually build out the grid infrastructure and get power generation, then that's a different type of mobilisation. It's about mobilising domestic project developers, as I mentioned. So a lot of the way we would do that would be through Global Ec, which is actually the biggest financier of independent power production in Africa, and we invest into Globalec that then provides relevant financing as well as technical support to start to build out those projects that can then attract other forms of financing. So I think what's also this sort of complementarity between sort of public and private is, I think, increasingly critical when we look also at the transmission system, which I think we're seeing in many countries across Africa, as in fact many countries across the world, that the transition and clean energy transition will only really work or be feasible where there is sufficient grid infrastructure to enable greater penetration of renewables, but also to better maximize the system, if you like, as well. And that's where I think the role of public-private partnerships is likely to become increasingly important. However, there are a number of risks, particularly macro economic risks, which can make those types of projects, really big projects, can be particularly challenging. So that's where we might also see the role of others coming in to provide guarantees. And I know, for example, MEGA as a complementary that provides risks to the sovereign can also help unlock new forms of private investment into that kind of grid infrastructure, which is so important as well.
Thank you very much. And Taliola, could I just ask you, you mentioned that I think you effectively said carbon markets shouldn't be seen as a kind of silver bullet. They're part of the solution, but they're certainly not all of it. And I just wondered if you could say a little more about the things that need to happen to regulate them properly so they can be as effective as they can. If you're able to address that, that would be great, as well as any other comments you want to make on mobilising that climate capital.
Thank you. So one of the key things, and and this is with regards to, just confirm that this is with regards to the carbon markets and RECs that we just spoke about, right?
Yeah.
Yes. Okay. I was just clarifying. So something that is very critical, especially for developing countries, is the fact that there's a lack of regulatory and policy frameworks. Now, why this is so critical is that what then happens is that where it's more we're prescribing, or there's a lot of prescriptive strategies that actually speak to, okay, this is what needs to be done, as opposed to an evaluation and assessment of the capabilities of the different countries, which vary from country to country. So using the African continent, for example, as a case study from the work that we have done, is that a key challenge, and a lot of the comments that we've gotten from investors, is the fact that, there's no clear regulatory structure or frameworks that are put in place. Why this is also so important, as well as it's good, for investor confidence as well. On the other hand, it does protect the governments as well with regards to guardrails towards what a good carbon market ecosystem looks like, and even with regards to what is being prescribed as good, they're able to judge and assess that these are viable and this is what is needed for my country at per time. I think something that is very and we've been able to map out key challenges and also key proposed solutions across the value chain, cutting across demand, intermediation, and supply. We know that there's a lot of challenges with regards to understanding and even capacity of what carbon markets are. And what we fail to realize is that it's a lot of this government, it has become, sort of the language or a buzzword of, okay, this is the solution. This is the financial solution to, a lot of challenges, and that's how it's being portrayed. But really, it's meant to be an incentive to drive climate change. But at the same time, being able to trickle down to really support development by way of indigenous groups and local communities. So I think collectively, something that needs to be done in really even driving the use of this instrument is the fact that there has to be better coordination and collaboration. The standards themselves need to be heightened, especially for voluntary markets. You know, we have the likes of the VCMI and ICBCM really serving as guidelines for both demand and supply, but we really need to collectively ensure that these principles are, you know, followed through and they are implementable and they are enforceable to the point whereby, with regards to the market dynamics, it cannot go around what has been established as the principles and guidelines for operations within these markets. This, you know, and we always talk about protection from you know, from the project pipeline end of, you know, ensuring that, you know, there's viability in projects, quality and integrity, which are very critical. But we also need to talk about integrity also from the demand end of things, whereby we ensure that, you know, these countries, based off, you know, the expectation and excitedness about having this, you know, finance key challenges, which we know that financing and, you know, this income is critical, aren't subscribing to substandard solutions or proposed solutions that in the long run actually have negative impacts on the countries or their growth and development. So I think that unified approach of having those core principles that guide the market is something that is really lacking. And there's been so many initiatives, there's so many things ongoing that, you know, collectively actually bring confusion to the ecosystem. So you're not actually able to articulate a key drive towards what is needed and how it will be deployed. And that's why I keep saying it's more of the how as opposed to the what. So those are just my initial thoughts on that aspect.
Thank you very much. Thank you. Patrick.
Thank you, Donny. Thank you. So my next question is to Dr. Songwe. Again, maybe touches on some of the issues that have been raised. But Dr. Songwe, the question is, what reforms are needed to the bilateral, regional and multilateral finance system to increase the quantity and quality of climate finance in a way that supports a just energy transition in Africa? And is there a role for the extended BRICS countries to play?
Thank you. Thank you very much. I think the first piece of reform is really around our shareholders to the MDBs. Of course, in the IAG report, we talk about the commitment of the shareholders to increase, or at least to commit to capital increase. We know that a lot of the MDBs now have to stretch their balance sheet. I think there is some conversation that must be had with rating agencies so that the MDBs should be able to do more without fear of downgrades and their AAA rating. I think that's the first one. In the report, we talk about a bigger, better, and bolder bank. A bigger bank, of course, is additional capital that should come. I have to say that between the World Bank and the EIB and the Inter-American Development Bank, just by following on to the CAF report, I think they've been able combined to raise already somewhere in the order of $60 billion, if my numbers are correct. So clearly there was a lot more that they could do by way of sweating their balance sheet to do that. A bolder MDB system means a system that is able to work more and better with the private sector. I think one of the quote unquote good news is that last year, $1.2 trillion was deployed for climate change expenses. Unfortunately, almost 90% of that was done in the developed world. So the gap between financing of climate activity in the developing and the developed world is still very low. But that requires that the MDBs are able to use more of their guarantees today on the mobilization. For every $80 billion that the MDBs spend, they mobilize 17. So essentially it's 0.2 or 0.3 of the mobilization rate. What we need is the other way around. We need for every 17 billion, they mobilize 80 billion. And so reforms around sort of getting the MDBs to report on mobilization, to report on leveraging is going to be quite important. I think as we talk about, financing, there's new and innovative things that are being done out there, like debt for nature swaps. We just saw something in Ecuador, the Galapagos bond. You need, and this is the Better Bank, you need a different kinds of skill set to be able to deliver on some of that. And so some reform around, maybe now that we have changed the mandate of the bank and added, the climate mandate, maybe getting a skill set that is able and amenable to working with the private sector to do this is going to be particularly important. But the most important, I think, piece of this MDB system is for them to work as a system. We do not want for every country to have to do a country climate report for the World Bank, for the African Development Bank, for the IADB. We need for them to be able to work as a system so that they can rationalize the demands and the needs on client countries, but also help them to, develop their just transition plans. I think we saw a very good example in the case of Egypt and the NOAFI program, where Egypt took ownership of the program, but the MDBs were able to collectively come together, bring in the private sector and put out a plan that today is being funded almost to the tune of $8 billion within the space of 1 year. So it's doable to crowd in private finance, it's doable to crowd in the rest of the MDB system. On the guarantees, one of the things that we're looking for is that, hopefully our shareholders can allow for guarantees to be shared across platforms so that we don't end the fiscal year with one MDB having some more guarantee room to run, but another MDB not being able to close a deal because they need some guarantees. I think that at the end of the day, all of these MDBs report to the same shareholders. And so being able to sort of use the balance sheets of the MDBs as a collective is something that we hope that that reform can go forward. This is for the MDBs. There's a lot of work that needs to be done on the IMF. And if I have 2 minutes, I just want to say that quickly. I think on the IMF, we've seen the Resilience and Sustainability Trust, $40 billion of the SDRs. It's fantastic. But the global community needs a lot more liquidity. I argue that we need climate SDRs, new issuance of climate SDRs. And that this new issuance of climate SDR should not be given as a quota system, so voice reform, but maybe given by impact. Countries that are the most hurt by climate should get a larger share of these resources. And I think that that's something that we can do while waiting. The SDR on lending program, I think, should be on the table. I think we need to be able to provide SDRs to also the regional development banks. The African Development Bank has made a very strong case for that, the Inter-American Development Bank as well. And then on the loss and damage, I think, as we said, not all countries are going to be able to build resilience or have built resilience. And if you take again Mozambique, we keep on using Mozambique, but if you use Mozambique or all of East Africa that is suffering droughts, it's very difficult for 3, 4, 5% of your GDP to be hit by climate and for you to still continue to pay your debt. Mia Motley and the Bridgetown Initiative have suggested that if you have a climate event, we should immediately suspend all debt service payments for a period of 3 to 5 years so that the country can use those resources to be able to manage the climate crisis at hand. I think this is something that we could do, and we could do quite quickly. I think the World Bank has already said they will do it, the Inter-American Development Bank, but getting all of the MDBs to have that kind of sort of suspension clause in all lending is going to be particularly important to help with the sort of loss and damage shocks that many countries are having as we go forward, and then providing some additional liquidity as we do the IMF review to see whether, the IMF has a number of policies on hand where if we change them and provide liquidity upfront, as opposed to waiting for the common framework, which is not kicking in to kick in, review and revision of the common framework is going to be particularly important, but just reviewing and revising some of the IMF lending policies so that they can be not lender of last resort, but liquidity provider of last resort before a country goes under will be particularly important. So this is a little bit of a bucket of reforms that some of them are just, at the IMF board, we could change them, at the World Bank board, or at the MDB systems board, they could be changed, but some of them require shareholder agreement for us to move forward. Thank you.
Thank you. Yeah, very helpful indeed. And then Another question to Mapuka, and maybe looking at it from a slightly different perspective. What are the expectations of civil society within Africa for international finance system reform and transformation, with a view to mobilising just energy transition finance in the continent? And what reforms need to be made to existing funding channels and mechanisms?
Okay, thank you for that. I think I alluded to this earlier when I mentioned, I think at an international level, there needs to be reform of the international tax system. So for example, right now at the UN, there's a process that's happening where countries were voting recently to move global tax policy reform from the OECD to the UN to make it a more inclusive and democratic space. And in there, the argument is we need more global South voices, we need more African voices in there. So how do we ensure that we have the African voice in spaces where global governance is taking place, for example, around unlocking financing and tax? The tax space is one of those. So that's number one. How do we reform international frameworks? How do we reform international global tax policy to ensure that that works? Another thing that we've been pushing for really is to ensure that domestic laws are progressive enough. So how do we ensure that the laws that are in place, for example, are not penalizing the poor? So when you think about, for example, tax incentives being awarded to big multinationals at the expense of consumer taxes, where citizens are being levied more. So how do we ensure that we have more progressive tax systems at the domestic level to ensure that reform happening at the international level also complements the domestic level reform? I think more and more, lastly, is how do we create spaces for civil society, right? Civil society represents the people. At the end of the day, the MDBs give the money, but the impacts are felt by the local actors. How do we ensure that those really at the bottom, those at the front line of climate, facing the negative impacts of climate, are in rooms like this to tell their stories, so that then that informs some of the global policies that are being put in place? So that is really the civil society cry, that more voices be part of the process to ensure that there's equity and justice at the end of it. Thanks.
Thank you very much. Now, I think we have potentially just a few minutes for questions from either online or from our audience. I shall look across the room. So are there any online questions? No? Are there any questions from our audience? If not, we will I'll give you a minute, you're behind me. But if there aren't, then I think we'll move on to the second panel. Do we have everybody present for the second panel?
Yes, we did quickly as well.
Excellent. Well, thank you very much. And I know it's absolutely of an advantage to do this, because I know that Patrick, you've got to go slightly early. So, but I want to thank all our panelists who've taken part. And please, please stay if you're able for the next session. But it has been incredibly informative, very helpful to me certainly. And I have Professor Richard Callan, I can see, who is from the
Thank you.
Yeah, so thank you all of you who've spoken so far. I can see that Professor Richard Callan from the Cambridge Institute for Sustainable Learning Africa office, I think has shown his hand. So as we have a couple of minutes, I'll just bring him in. Richard, do you want to ask a question or make a quick comment?
Thank you very much, Chair. Thanks. Thank you, Lord Oates. I don't want to delay your proceedings, but I had made a submission, as you know, to the committee, and I very much welcome the proceedings that you've started here. I think it's very important that the British institutions such as Parliament are fully apprised of what's going on the ground. I just wanted to make two very brief points, and I'll keep them very brief because I know you want to move on. First of all, I certainly endorse everything that both Dr. Vera Songwe and Amole Amin said in their remarks, because I am also on the high-level expert group on climate finance. So I won't dwell on any of those points. except to say that the concessionality point is critical. Many African countries are absolutely struggling with debt. So that's absolutely critical. So we can talk about domestic resource mobilization, which is critical, but you can't do so without also recognizing the context of fiscal space being constrained. Secondly, the demand side matters, and Amolie spoke to this to some extent, that it's absolutely important that partnerships with countries in the global south recognize the need not just to supply the appropriate quantum and quality of finance and access to it, but also to invest in partnership with building up the demand side. And by demand side, I mean the human capital that must accompany the financial capital, the skills, the capacity, the training, all of that which will ensure that there are bankable projects that can innovate and advance the agenda. Thirdly and lastly, on the justice point, if I can put it very simply in terms of South Africa's experience here, the political economy is treacherous. And I'm going to put it in very simple terms, Chair, which one wouldn't perhaps put in a written submission. There are people in South Africa who wish to stand in the way of a just energy transition because they have vested interests of various sorts in that transition. The Presidential Climate Commission was a very important institutional innovation in South Africa to help navigate that, but it may not be enough. And one of the arguments that is put, and it's a false dichotomy, but it lands nonetheless, is that we are swapping coal jobs for increased profits to the shareholders of renewable energy companies in Europe. It's a false dichotomy because it's not a choice like that. But there is a grain of truth in it. And moreover, it lands in terms of the political economy. One of the ways to cut through that is to ensure that any investment strategy takes care of that by thinking about the ecosystem of transition. So not just renewable energy, but also the potential value chains that you can build up, the new industrial value chains that can be built up around renewable energy, ones that can create new jobs, safer, better jobs, not just in the renewable energy sector itself, but in the surrounding communities. That will help safeguard the justice part of the transition. And country ownership, and colleagues have spoken to this, country ownership is critical. And as Dr. Songwe put it, Egypt is a really good case study in a different way to South Africa, because both countries are seeking to take ownership institutionally and economically of this transition. And Egypt, I think, is a really interesting case study. And I commend to you Dr. Rania Al-Mashat, who is the development minister of Egypt, who speaks extremely well on this topic. So when you get an opportunity, I recommend that you engage with her. I'll confine myself to those comments. Thank you for giving me an opportunity to add to this important discussion.
Brilliant. Thank you very much, Professor Kelland, for that very helpful intervention. We're now going to move on to our second panel. I am going to start off by asking a question to Kevin Kariuki, who I introduced earlier from the African Development Plan. What role can and should debt restructuring and relief play in unlocking additional finance for Africa's just energy transition? What is the role of multilateral development institutions, and how can MDBs and their donors ensure that funding is applied in a way that contributes to just transition and crowds in other sources of finance? Can SDRs be better mobilised to deliver grant funding, concessional finance and investment? Mr. Kariuki. You don't need to press the button, just speak to the microphone. Okay.
Thank you very much, first of all, for having me in this all-party parliamentary group for Africa. That's a very loaded question, but I think to do justice to the question, I think the first thing I must do is to contextualize my responses. And I would like to start by stating that I envisage an African just energy transition as one that is anchored on the continent's vast renewable energy source of energy, as well as increasing grid interconnections of the continent's power systems. However, as Vera suggested and Amel suggested, to address the intermittence of wind and solar power, I expect that natural gas will be an important transition fuel providing the required flexible generation and enabling greater integration of renewables into the power systems. And I would say pending, and I emphasize pending, the development of cost-effective green hydrogen to replace natural gas in power production. And secondly, pending the realization of affordable energy storage systems or other clean sources of flexible generation. And this is why, as a bank, the Africa Development Bank is at the forefront of development of the Africa Continental Power Master Plan, which will underpin the establishment of an integrated continental power master transmission network. And secondly, we are also an integral part of the BEST consortium that was launched this year, but got alive at COP28, which is aimed at securing 5 gigawatts of battery energy storage systems deployments in low and middle income countries, including Africa. But just to clarify, because this is important, the proposed use of natural gas as a transition fuel in Africa's just energy transition is not at odds with the Paris Agreement. If, and I repeat, if it uses the continent's equitable portion of the remaining carbon budget, compliant with the 1.5 degrees Celsius, and considering the low historical emissions of Africa, Africa must be accorded the right to the remaining budget, which is estimated at 400 gigatons of carbon dioxide equivalent. Moreover, the transition must also be facilitated by adequate financial resources, as well as technical capacity to efficiently develop, operate, and maintain the emerging technological solutions. This will determine the speed of Africa's energy transition, and therefore the continent's ability to effectively complement global ambitions towards Paris Agreement goal. Finally, energy transition is country and region specific, whereas transition in a few countries in Africa must focus on decarbonization. Most of African nations it will be all about sustaining low carbon development trajectory because they are already, they hardly emit anything. That is, in other words, they will be involved in sustainably increasing access to electricity supply, growing their industrial base, and providing access to clean cooking for the billion people who still rely on wood or charcoal for fires for cooking. With this context, let me quickly address the questions that were raised. First of all, to start with, let me observe, as was also referred to earlier, that due to constrained financial resources, including by Professor Richard, and national budgets, many Africans are forced to choose between funding development projects and projects for sustainability and climate action. In this context, energy transition may not be a priority amidst development objectives such as increasing energy access and industrialization, as well as addressing the impacts of emerging regional and global challenges such as COVID-19. So debt restructuring and relief could therefore have an important role to play in unlocking additional finance for Africa's just energy transition. In this regard, I foresee opportunities for wider implementation of climate resilient debt clauses, which were referred to earlier by Vera, which provide payment relief through debt suspension in the event of climate disaster. Additionally, a debt for nature or climate swaps can strengthen the fiscal position of recipient countries, allowing them to repay their debt on better terms while investing in nature restoration and climate action. Meanwhile, MDBs have a distinctive advantage in playing a catalytic role in fostering government and private sector investments. This is because they bring together knowledge, affordable financing, and efficient risk management. They are long-term partners who have long history of working in the countries and bring all stakeholders together in a cooperative framework. As a result, and this is important, they are trusted by countries and have significant convening power. MDBs must therefore play a more purposive and productive role in helping countries identify, enable, and foster green investments. For example, when amending the bank's energy policy, prior to COP26, the bank committed to assisting regional member countries dependent on coal for energy production in developing just energy transition plans. That's very important. And as a result, and based on its honest broker standing and convening power, the bank has positioned itself to play an increasingly important central role in South Africa's and Senegal's just energy transition partnerships. A case in point is the recent bank-approved 1 billion FCDO guarantee, which will increase the bank's lending capacity for new and eligible sovereign guarantee projects in support of South Africa's just energy transition. Finally, the role of MDBs in crowding in source of finance, particularly concessional finance and climate funds, cannot be gainsaid, especially consider that Africa accounted for only 2% of global renewable energy investments in the last 2 decades. Accordingly, the provision of additional concessional resources to facilities with established track records, such as the bank's Sustainable Energy Fund for Africa, which is supported by the UK, is becoming increasingly important. This year alone, and this is very, very important, CEFA literally saved 2 solar power projects, a 200 megawatt Komombo in Egypt and a 100 megawatt Kairouan in Tunisia, amid significant EPC price increases due to COVID-occasioned supply chain disruptions. And regarding special drawing rights, the real benefits of SDRs is to enable MDBs to increase the lending volume in line with the call for MDBs to do more to help address global challenges. Moreover, and thanks to their unique business models, MDBs can transform SDRs from being static foreign reserve assets into lending instruments and multiply them by 3 to 4 times the SDR allocated, thereby availing additional resources to finance development projects and the private sector. Under the structure that was referred to by Vera, in which the bank is championing in association with the Inter-American Development Bank, the resources accruing from SDRs will be in the form of long-term loans from SDR-rich shareholders and will have to be eventually paid. Accordingly, although the resources made available to MDB borrowers and clients may neither be grant-based or not conservative in nature, they will be in usual MDB lending terms and therefore affordable with long-term maturities on account of MDB's AAA rating. An important factor to note is that in the model that the AFDB and the Inter-American Development Bank is proposing, it costs the taxpayers of SDR-rich countries such as the UK nothing to rechannel SDRs through MDBs. This is because MDBs, such as the African Development Bank, will make the SDR-rich country whole by repaying SDR interest that the IMF charges to countries that lend the SDRs. Let me stop there. Thank you.
Thank you very much. Thank you very much for that.
Very, very helpful. Thank you. So our next question is to Hubert Danso, who is the CEO and chairman of the Africa Investor Group, and I hope he's available online.
Yes, I am, if you can hear me.
You are. Great stuff, Hubert. Thank you. So the question is, how can we broaden the sources and improve the quality of private finance to support a just energy transition in Africa, including ensuring adherence to strong human rights and environmental safeguards?
No, thank you very much, Chair. That's a great question, and I've really enjoyed listening to all of my friends and colleagues speak. And as I sit here in South Africa, experiencing a little bit of load shedding right now, just having come back from sharing a number of different exchanges with colleagues from around the world about how they are crowding in long-term institutional capital. I do really wonder if we are trying to solve the private capital mobilization problem, or whether we are trying to continue to feed an existing multilateral development bank system that likes to give loans, and when we end up in debt distress, we act surprised and then we reschedule, and then we wonder why the private sector isn't crowded in at scale or finds our markets attractive. And as I listen, I'm hearing a great deal of let's sort of move commas around a paragraph. I'm not hearing the scale that we need, or that I'm hearing from other colleagues from around the world whose allocations are in that bucket that Vera was talking about, those trillions that are going into climate, but they're not coming to us. I think we know already that Africa needs, what, $3 trillion worth of investments for our nationally determined contributions by 2030. We already know that between the year 2000 and the year 2020, the world only mobilized about $2.8 trillion. So that effectively means that Africa is now expected to, or needs to, mobilize more investment in the next 6 years than the total stock of global renewable energy investment was mobilized in 20 years, 2000 to 2020, of which less than 2% came to Africa. So I just wonder why I'm not hearing a sense of urgency around a private capital market and mobilization market failure that needs an urgent and radical different approach and thinking to be able to address, because this climate crisis is not waiting on us to come up with the next best idea. So given that, I think we try to sort of come at this from the basis that, you know, there's absolutely no question that we need to address this private capital mobilization at scale market failure, and really look at how we can co-create and implement these future fit investment models and platforms that make mobilizing private capital at scale for Africa's just energy transition the expectation and not the exception. I think, first of all, we need to, as I sort of alluded to in some respects, if we extrapolate in some parts the private capital mobilization piece from this global financial architecture conversation, which basically makes a lot of my colleagues in the institutional investment community glaze over. You know, we are looking at how can we make strategic asset allocation decisions to very promising asset classes of the now and the future. But I think this sort of I would describe in some cases as a mischaracterization of private capital mobilization for Africa being an MDB green finance agenda. You know, is really worrying us, and you know, looking at some of our assets that we have on the continent, that we're running our governments into a lot of potential debt distress. So that's a really prominent concern for us. And we think we need to be thinking about scale from the private capital mobilization perspective, and really work with the pools of capital who are best placed to be able to deliver scale. If you look at institutional investors and, you know, particularly pension funds and sovereign wealth funds, our constituency commands in the region of about 150 to 200 trillion dollars of assets. We're 900 times larger in asset terms than most MDBs, who have a collective balance sheet of about 1.5 trillion dollars. Which includes the World Bank, the African Development Bank, all combined. But yet our leaders are spending about 90% of their efforts on the private capital mobilization agenda, working with the MDB community to catalyze us as the private sector and optimize those balance sheets, who after the reforms, we argue, will not even be able to cover 10% of the financing gap. And we're spending less than 10% of our time working with institutional investors who have the balance sheet capacity, if the legal and the regulatory framework and the different levels of trust are established and built, have the capacity to work very hard to close in the region of 90% of this gap over time. This is a medium to long-term investment agenda, as opposed to a short-term green finance agenda, in our humble opinion. So from a domestic and a global asset owner's perspective, and to sort of assist, address this private capital mobilization market failure, our overarching goal is really to see how we, as the domestic as well as the global institutional investment community, can help co-create, design, and deliver greater public-private finance mandate alignment and more catalytic private investment pathways that fast-track and scale private capital's participation in the just energy transition, implemented through institutional investor public partnerships to mobilize private capital at scale and ensure that capital can be deployed at speed. The world is changing all of their legal and regulatory frameworks, Inflation Reduction Act, Net Zero Industry Act, but yet we come back to the same development models, again, moving the comma around the paragraph, expecting that to be transformative. So I think like the rest of the world, we need to really think in terms of how do we send the right market signals to the private capital, to the global institutional investment community, that Africa represents an investable opportunity. And I think one of the key assets that we've had, I think everyone's already spoken about all of our natural endowments, our superabundant natural capital, our key green critical minerals. I think this is the opportunity to enfranchise those disenfranchised communities as part of the just transition, to really be able to focus on positioning and working hard to position Africa, and African green infrastructure and African green industrial infrastructure as a globally competitive investable asset class, and see how we can leverage the likes of the Nairobi Declaration coming out of the Africa Climate Summit as a supporting, enabling framework that can really build and deliver confidence in the market. I think the way that a lot of our colleagues are thinking about this is if we might need to consider stop trying to really force investment to be developmental, because you're going to get a small group. You're not going to get to the scale, but you may have a nice couple of public relations examples. But if you really want to get to the scale, our argument is that instead of trying to make investment developmental, we should be rather trying to make development investable. And we believe that we've got enough assets, and if we price those assets equitably and stop looking the other way, whether it's carbon and all these other resources that we have that we seem to be acting as the largest donor in the world, just giving them to the rest of the world to add value to, I think the story would be very different. But we need to begin to not look at ourselves as this development project that has no way out of that restricted environment, but rather we need to be able to look at a bigger, broader relationship with the larger pools of capital. So last week, for example, at COP28, we were...
Sorry, I'm sorry to interrupt you. I'm just conscious that my colleague Patrick has to leave at 5. We will continue the discussion, but he has one more question. So could I just ask you to quickly conclude your remarks, and then there'll be a further opportunity to comment.
Yes, so I think just in closing, I was about to just take you through some very high-level points that we issued as a collective of institutional investors last week at COP28, bringing together a collective statement from the Net Zero Asset Owners Alliance, GFANZ, the Institutional Investor Group on Climate Change, Sustainable Markets Initiative, and ILN, where we actually said that this conversation needs to really be elevated to heads of state as the plenipotentiary supreme sovereign governors of the multilateral development banks. And we sort of talked about a few key areas, and I think a number of them have been touched on: improving the bankable pipeline. If you want private capital to be mobilized at scale, it's got to be mobilized into a bankable or investable program or projects. Right now, we're seeing a lot of those projects being developed with development finance, if they're lucky, and therefore those projects are designed to attract development finance and not private capitals. So we think that absolutely needs to be addressed. I think there are a lot of long-standing issues around the private capital mobilization ratios and addressing the incentives of the actual MDBs to be able to crowd in private capital. If you're providing $1 of finance and you're supposed to deliver $10 of private capital and you're only delivering 20 to 38 cents, I wonder why that continues to be the constituency that has the full responsibility to mobilize private capital at scale in record time. That doesn't seem quite right. And in terms of improving data...
Sorry, I'm just going to pause you there if you don't mind, and we'll give you a little chance to finish those points just in a minute. But I'm just keen that Patrick, whilst he's still here, has a chance to ask the next question, and we will come back to you in the broader question. So sorry to interrupt.
Thank you. Yes, sorry, thank you, because it was a very, very useful response. But my next question is to Iskander Vernois from the co-chair of the Climate Action Network, Climate Finance Working Group, and the co-founder of the EMAL initiative. And another question about the expectations of civil society within Africa for international finance system reform and transformation with a view to mobilising just energy transition finance on the continent. And what reforms do you think, Iskander, need to be made to existing funding channels and mechanisms?
So hello there. Thank you for the question, and I will I'll respond based on a set of principles. A set of principles that were developed earlier this year by the Climate Action Network, which, by the way, is the global network for climate, or NGOs working on the climate issue, and the official observer constituency for over 2,000 of them in the UNFCCC process, and I speak to you from Dubai. So obviously we present these in the overall context of the shortfall of trillions of dollars needed for Africa's climate and sustainable development goals, which others have noted. And the assertion that under current systems there is no real prospect in the absence of significant change that those finance needs will actually be met in the urgent timeframes which they are required. And so, responding to that, we put forward just a 7-point set of principles for transforming the financial system. Our starting point is one that has been alluded to just recently, which is the structure of the global economic system, and that includes the systems of value creation and the fact that Africa suffers from being an exporter of low value added commodities relative to the imports that it imports. And this obviously is also true in the context of the energy transition, with energy technologies being imported and critical minerals being exported for value add elsewhere. So something that must be rectified if we're going to rectify the broader sort of financial imbalances. Secondly, with respect to the international financial architecture and its institutions, we come at this from the supposition that Africa's needs are best understood by Africans, and that the current international financial institutions are governed in ways which give undue voice to or disproportionate voice to non-Africans and undermine the African voice by and large, although there are important examples of multilateral institutions that give a fair representation to African representatives, and these are institutions that should be prioritized. And I think we saw calls to this effect coming from the African community at the recent meetings of the Bretton Woods institutions in Marrakesh in Morocco. Thirdly, around the topic of debt justice, and this has been something that has been alluded to before. I think it must be underscored that Africa is currently prevented from undertaking essential investments and funding for its climate and development goals as a result of servicing exorbitant debt servicing costs, including notably to private external creditors, which have been exacerbated as a result of the recent financial, the poly crisis and its financial implications. So definitely a need for better systems, as we know have been internationally acknowledged as being needed for debt restructuring and cancellation, and more broadly better systems for debt sustainability and equitable access to capital on better terms. Fourthly, tax justice, and I think this was alluded to earlier. We have an international tax regime currently, which is dictated by, largely set by the OECD, not by Africans. And the African proposals for a reform of the tax regime under a UN-led process it is expected lead to not just greater fiscal resources for African countries that could be so valuably deployed towards climate, energy, and development goals, but would actually indeed increase fiscal resources for developed countries outside of Africa. It's important to note. And we believe that there's important roles here for instituting taxes on polluting activities, but obviously this has to be done on an equitable basis. Fifthly, the need to reorient financial flows, particularly public financial flows, away from socially and environmentally harmful activities. And this includes some of the activities in the energy sector, notably in fossil fuels, which I think tend to have their potential contributions to Africa's development exaggerated by vested interests.
Just to say, if you could
sorry?
a minute, just to say you've got about a minute left.
Yeah, I've just got the final two principles to go. So the penultimate one is that climate finance has to be responsive. If it is to be just, it has to be responsive to those most marginalized communities that are on the front lines of climate change and who are lacking in terms of their energy needs, which is not a given. And then finally, and I think this might be a point that we'll unpack later, just in terms of the scale, there has to be sufficient truly new additional grant equivalent finance from developed countries, such as the UK, to developing countries to meet their commitments under the United Nations COP process. And it has to be additional rather than subtractive from existing development finance commitments, if it is to meet the commitments that were undertaken in Paris and Copenhagen. And I'll stop there, I suppose.
Thank you very much. Thank you for that. I need to thank Patrick, who has to go to another meeting. Thanks very much for the lecture. Second part. And now I wonder if I could turn back to you, Hugo, and I'm sorry to interrupt you, but I wanted Patrick to have here as much as possible and contributions from everybody. You're making some very important points about the things that you felt needed to happen. I wonder if you might just conclude those.
Oh, thank you very much, Chair. No, I think I'd almost concluded on those points, but I was really just talking about the need for a different strategic partner at the table to address scale. Because we seem to have the people that haven't been able to deliver scale from the private sector now leading the charge to mobilize it. And I wonder how logical that is. And I think the results will speak for themselves. And I think the outcomes could be tragic for all of us, considering we could accomplish a much better outcome if we all collaborated a lot better. If it comes to mobilizing public capital at scale, I don't think the private sector or the investment community are the best place to be able to co-lead that effort. I think the public sector know how to mobilize concessional capital at scale. For this emergency where we need urgency, for private capital mobilization, the institutional investment community need to be around the table. We need to be actually leading in the design of this. A $1.5 trillion balance sheet cannot catalyze and mobilize anything close to the trillions that we need. The math will never work. So we need a different level of institutional investor public partnership. And I think we were just showing ourselves, that's where I stopped. As the institutional investment community, we came to COP. There's a finance day. We always tend to sort of be sitting on the end of panels led by multilateral development banks and DFIs who don't have the trillions to be able to, we should actually be leading that effort. So I think what we're trying to say is we need to philosophically align with who is best placed to really deliver the scale. Otherwise, we'll be continuing to talk about the scale. We need data, sir. We need data. We have been asking the multilateral development banks for a decade now for access to the global emerging markets database so we can appropriately price risk and increase our allocations so that we can actually deliver more finance and investment to emerging markets, developing countries, and Africa, of course. 10 years we've been waiting for this. It's costing our governments on the continent $15.6 billion each year in excess interest payments on loans by not having access to that. And it's a no-cost exercise for some of these institutions. So I think what we're really trying to say is that we need to tackle the elephant in the room if we want to get to scale. And I'm here just to signal to you that the institutional investment community in Africa, the pension funds and the sovereign wealth funds are working very closely and collegiately and collaboratively with the global institutional investors to see how we can establish Africa as a globally competitive investable asset class, how we can create the right level of offtakes for green manufactured processed goods and technologies so that we're actually servicing and supplying the $10 trillion and growing per annum global green industrial economy. And we think that there's a lot that the British government could do. We're part of a group of 12 British pension funds representing £400 billion with about 18 million members who share our philosophy, but they don't seem to have access to the British government, who we believe could really be critical in catalyzing this effort. We tend to sort of really be focusing on the same sort of development instrument. So that was really my point. I'm just going to send a high-level message that on scale, I think we're going in the wrong direction if we think that these conversations are going to deliver it. But I think that there's a unique opportunity that the British government have with its long-standing commitment and alignment with Africa, where British pension funds, British institutional investors could work with African institutional investors, particularly around the JETPs. We could be looking at how can we add value, bring British technology, working with African minerals and expertise located in African green industrial cities, and how can we collaborate as Africa and Great Britain in terms of being able to not only service Africa's own transformation, but also support Britain's transformation and then service the global green industrial economy for the mutual commercial and climate-related benefits for both of our markets. And I think that's just where I'd like to leave it, if that's okay. Thank you very much.
Thank you very much for that, Hubert. Can I now turn to you, Kevin, with another question, which is related to fossil fuel subsidies. Do you feel that they should be phased out, and could this be a way of finding some of the extra funding for the energy transition that's required, and how can negative distributional impacts and resistance be mitigated?
Thank you very much. As we all appreciate, subsidies are intended to protect vulnerable consumers by keeping prices affordable, but they come at substantial cost. Of course, invariably, removal of explicit or implicit subsidies would result in price increases, which could in turn lead to social unrest. I think just to provide context, in the case of fossil fuels, some of the implicit subsidies relate to external costs, such as contributions to climate change through greenhouse gas emissions, local health costs, including premature deaths because of harmful particulates, as well as, of course, as traffic congestion and expenses arising from motor vehicle and road accidents. The right energy price would entail incorporating the cost of these adverse impacts on society. And this is found interesting. According to the IMF, raising fuel prices to fully efficient levels would reduce projected global fossil fuel emissions by 43% below baseline in 2030, which coincidentally is in line with the reduction in global greenhouse gas emissions required for the 1.5 degrees Paris goal. This is also indeed consistent with the calls at COP26 and repeated at COP27 in Sharm el-Sheikh for countries to accelerate efforts to phase out inefficient fossil fuel subsidies. On this basis, I think the fossil fuel subsidies should be gradually phased out, and the resulting financial gains used to fund energy transitions that also, this is very important, safeguard energy security and affordability of supply. In Africa, the financial gain would also be used to support increased access to electricity supply, as well as clean cooking solutions and technologies to mitigate distributional impacts and resistance. But in my view, the most effective means of mitigating negative distributional impacts and resistance, and I think this was alluded to by somebody earlier, is through public ownership, I think it's by the professor, public ownership of just energy transition established by transparent as well as extensive communication and consultation with stakeholders. I think if you ask me, on the South African just energy transition, this is one area that it failed. It was a political declaration that was made sort of just at the COP, but there hadn't been sufficient consultation to make sure that all the parties in South Africa were agreeable. So you find that there's a lot of discordant sort of statements coming from governments. So suffice it to say that the African Development Bank is involved in ongoing policy-based operations to gradually phase out electricity subsidies and establish cost-reflective tariffs in Egypt, and it's been very successful. Finally, I think this is also very important for us at the bank, is that measures for phasing out implicit subsidies, such as the EU Carbon Border Adjustment Mechanism, which was alluded to earlier, must factor in contributions to historical emissions, and equitable right to remaining carbon budget. Otherwise, Africa will be penalized for a problem it had no idea and it did not cause. Thank you.
Thank you very much. Thank you. And then, Iskander, could I turn to you? And I think, as you mentioned, you're just joining us from the COP yourself. Can you just give us your thoughts on the role that the COP process can play in mobilising just energy transition finance, and in particular update us on any developments while you've been there, positive or negative?
Yes, I'm happy to provide some context. I mean, I think in terms of the energy transition and its financing, I think we need to recall the spirit of the Paris Agreement as it was adopted in 2015 to understand where we are today with the COP process here in Dubai and beyond. So the Paris Agreement obviously brought together a number of intended nationally determined contributions for reducing emissions and transitioning energy systems, which would be insufficient to keep the world below dangerous warming. But it was understood, the assumption was that over time, more ambitious energy transition commitments might be made by different countries, and indeed that more finance would be made available by developed countries to help developing countries to do so, and that both would be increased over time with a sort of cyclical process of pledging and reviewing with the so-called NDC ratchet cycle, and now, as we have here this year, the global stock take on a 5-yearly basis. However, unfortunately, since Paris, the public finance that has been committed by developed countries hasn't been additional. by and large, to the development finance that had been pledged in prior years. And I think that this is leading to quite a clash in expectations, and I think we'll be seeing more of this as the COP concludes, with between African countries on the one hand and the developed country contributors to climate finance who are responsible for the climate crisis. So I think that it's to be understood, of course, and recognized that the context that we're in is one where there are increasing demands for finance, both in terms of increased needs for climate adaptation, as well as now new expectations in terms of provision of loss and damage finance, in addition to various other areas requiring development assistance, humanitarian and refugee crises. And so therefore, I think we have to have responsible conversations about the sort of percentages of GDP allocated by developed countries to overseas development assistance, and revisiting targets that were established in the 1970s that aren't adequate to the challenges that we face today and the needs for different types of finance.
Thank you very much for that. And lastly, can I just turn again to you, Hubert? So we've had a number of contributors have referred to the JETP in South Africa and some of the challenges it faces. And I wonder if you might just be able to briefly comment on how the JETPs are perceived in South Africa and in Senegal, how they're received and how just and effective they are.
Thank you. No, I think colleagues have really touched on that. They could have absolutely done a lot better, if they'd been consulted on a lot earlier and a lot more extensively and widely. But I think you'll appreciate that no one in South Africa is going to turn down 8.5 or so billion. So they're sort of being accepted right now. And we've already seen the investment plan that's associated with the JETP. So we've tried to sort of figure out how can we make it, it investable, because there was a hope that it wouldn't be so loan heavy, that it will be much more concessional. There's a lot of activities associated with that transition that can't deliver a market appropriate return or even cost recovery. So we would expect that there would be, and there is a deep expectation that they need to be significantly more concessionalized, if I can use that phrase. I think that, as we begin to look at how can we leverage the investment, I think we're talking about 90+ billion will be required from the private sector, and the private sector were really marginalized from that particular conversation, particularly the constituencies that we work with, the local pension funds. Interestingly, we work with British pension funds, and they're asking, how can we get involved in the JETP? So we're now having to sort of go back door, because the process has been seen to be a development instrument, and you've got an investment plan that is currently out in the market for public consultation, which is called the implementation plan, which is linked to the investment plan. And hopefully, maybe Senegal might learn from some of these experiences about how to go about that. But I think one critical area, and we've heard a lot about it, is the project development equity, or the project development finance, or the project development grants. A lot of that money that comes with the JETPs is only going to be accessible if there's a bankable project for it to land in. And those particular projects come with some very specific and technical requirements, which add even more cost to the project development process for them to be compliant. So the ability to maybe find a way to collaborate and support or divert more resources to the project development space. We know that the governments have been supported with about 300 million to help build their capacity, processes and systems to be able to administer the program. But the private sector are really lacking the resources to be able to develop the pipeline of projects. So I think that's part of the challenge, but I think that's also a good opportunity as well, given the institutions that you have. Final point, sir, is that we, as I mentioned earlier, we see this as an investment agenda. And we keep looking at these issues that need scale, that are, you know, very significant in terms of numbers. And we have to realize at some point that we would encourage governments to go to the market and borrow. In the same way that you borrow to invest in domestic economies, you can borrow to invest in Africa and other emerging market economies and seek a return on that investment and have and send a very strong market signal to the larger pools of capital that we have a partner, an investment partner in government, as opposed to a business or a development partner, a development business as usual partner, which we know is suboptimal in terms of addressing the scale. The work is important. The development budget does important things. We're not saying it doesn't, but we're saying if we are going to get in front of this climate change and if we're going to deliver these sustainable development goals, we need to rework our mathematics. And I think we can all do that, and I think we can do that for mutual benefit and gain. People, planet can all benefit from that. So perhaps let me stop there, sir.
Thank you very much. Thank you. As I mentioned earlier, we have with us the chair of the World African Society, Aruna Otte, who also has huge experience in the MDB world. So I'm now going to turn to Aruna and ask how she could make some comments on today's proceedings, and over to you.
Thank you, Lord Otis, and I was listening to each of our panelists. And each time each of the panelists shared a perspective, I thought, yes, that has to be the way to go. And I look back on my 40-year career, but 31 years since I first started hearing these topics. And I have to say that for me, what is different is that there is a little bit more excitement. There are more practical examples. And there are more people at the table with different perspectives. So that's what's different today versus 31 years ago when I first started to hear these conversations. And so some of what I've heard today from the panelists include what I would consider that we should take an ecosystem approach. Even though when I listened to Hubert, who I've known for 30 years, he always seems to say, please just choose us, the institutional investors. And I hear your point, by the way, because I was thinking about you, I was thinking 1.5 degrees, don't focus on 1.5 trillion from MDBs, but focus on the 150 trillion from from the institutional investors. And I hope that you can agree that we should focus on all the above. So an ecosystem approach is absolutely important. I really liked what Madam Anil said around early stage capital, the role of equity. And I'm really, really proud of BII that 75% of what you do is really focused on equity. And the same case is made by Dr. Somewhere, who talked about, and others who talked about the value of grants and concessional resources, because you do need early stage to be able to attract the pension funds. I was myself, part of the G20 task force that first looked at how MDBs can be reformed to be able to leverage them better. I will still argue that there are some of the most amazing leverage machines in the world. The example that I often give is that the World Bank was started in the 40s, and all of the shareholders have had to put in the World Bank has been $20 billion over 75 years. And that has raised $1 trillion that has allowed all of the governments to come together and craft the path together. So things like the Paris Agreement and all of the other things that come together come because you can convene everybody together. And so we should not lose the value that MDBs provide. I like very much the contextual issues that were shared around it's not just the money. I think Dr. Songwe talked about the fact that the policy environment needs we need to continue to work on the policy environment. Dr. Karuki, Ms. Amin, and Dr. Songwe also talked about the importance of Dan also talked about the importance of project preparation, the project pipeline, bankable projects. We need to fix that. And part of what will fix that is also the concessional resources. For me, what is exciting is that there are practical examples. I think Dr. Karuki shared a number of practical examples that come from his wealth of experience. And I liked his point about some of the things that could make things work, like JETP South Africa could have worked better if it wasn't just a political declaration. And some of those nuggets are extremely important as we think about how we go forward. Mr. Amin talked about grid works and what it's done. Dr. Songwe talked about the Nexus WFE, because I could never say the NUFU as everybody tries to. So I do think that there are a lot of innovative opportunities that we have that we can rely on. I do, notwithstanding my joke earlier, agree with Dr. Hubert's answer around skill, the sense of urgency, and the mindset change. But everybody needs to be at the table for that to be able to happen. We need everybody working together. And I wanted to, if I can just say, that I know we're getting to the end of time, to say to you, Lodos, I cannot thank you enough for your commitment to this, because you visited South Africa and you came back and said we need to make sure that we truly understand what Africa's perspectives are on just energy transition. And this is the second oral evidence session, but we also had another session with FSD Africa presenting on how you mobilize domestic capital. And I'm very excited about what we have achieved by bringing all of these voices and these experts who ordinarily have not often had in the UK. And I hope that the work that what they shared with us will help us in moving the agenda forward. I can't thank the panelists enough. I know some of you very, very well, and I'm really, really delighted that you made time to be with us. I like the conversation about carbon markets. I think it's much more pragmatic as to how do we achieve that. I thought the fascinating conversation about tax was also interesting, and I'm like, if we get all these resources, surely we'll be able to meet all of the needs that we have. I want to thank the special advisory group, and I see that our former CEO of the Roland Society is here with other colleagues for the work that you're doing in the background. I want to thank the Parliamentary Committee on Inquiry. This has to be the best inquiry you've done so far. But we will see, because I think we still have to get more evidence and then have the report that will be done. So I thank our knowledge partner, Oxfam, but I also have to thank my team at the Royal Africa Society. They've just been amazing, and particularly Hetty. It's a very small team that does big things. Thank you so much, but I think you inspire us to be our best selves. Thank you.
Well, thank you very much, Runa, and may I echo the thanks to all the team at RAS who have been so helpful, so supportive, and done such a great job in bringing together such excellent witnesses. I want to thank obviously all those who've given evidence both today and previously, And it's clear that the scale of the challenge is huge, and also that the opportunities are great. But one of the things, as Aruna alluded to, is the fact that I think in Parliament, in the UK Parliament, understanding has been low of some of the issues, and certainly, you know, I think there was a feeling after the JP was signed that, oh, that was great, it was fantastic, and it was all done almost, and that certainly you know, wasn't the case when I visited South Africa, which is a place that I know well. So I'm really grateful to you for bringing these perspectives. And I hope that the report will be a really good tool in ensuring that Parliament and government policymakers are much broader understanding of this. I certainly learned a huge amount today, as I did in our last session. So thank you to each and every one of you. I'm sorry for curtailing some people. I would love to hear much longer, but the time is limited. And on that note, at 5:30, I will call a close to the session. But huge thank you to all of you online.
I did forget to acknowledge the Afri-Exim Bank and Africa No Filter for the support they've also given to this inquiry. Thanks very much.
Yes, and also echo that. Thank you.
Good luck.